In the late 80s, an IRS employee saw a Rolls Royce parked at a restaurant in an area of town that seemed a little out of the ordinary. This would eventually lead to the imprisonment of Anthony and Shirley Olbrez for criminal tax evasion. Hi, Logan Graf, Certified Public Accountant here. If you ever have a professional prepare your tax return, know that you are presumed to know its context when you sign it. Carelessly signing a tax return with the assumption that it's right is a bad idea and does not give you any credibility for innocence if you are audited. Now back to our story. Anthony Olbrez of Exeter, New Hampshire started a business called Design Consultants that involved designing, fabricating, and selling trade show booths. Design Consultants started off as a small business, but Anthony grew the business into a successful enterprise with gross receipts in the millions and some of the biggest corporations in the country as clients. Industrial designer by education profession, Anthony was responsible for the business's design and fabrication work, marketing, and its billing. Shirley Olbrez, Anthony's wife, maintained the financial records for the business on a part-time basis, even though she didn't have training or experience in accounting or bookkeeping. The financial records were generally sloppy and contained lots of errors, which is a surprise because accounting is so simple. 2 years after forming Design Consultants, the Shirleys hired Wilson Dennett, a local CPA, to provide accounting and tax prep services. Wilson was known as a competent accountant and honest. Sounds like a great guy. Wilson would prepare financials, assist with financing, provide accounting advice, prepare tax returns for their Olbrezes. He did not perform in-house bookkeeping or record keeping for the business. That was all Shirley. Having developed a taste for the finer things due to the success of their business, the Olbrezes purchased a Rolls Royce Corniche convertible in 1987 for $158,000. Later on in 1989, an IRS employee noticed the Olbrezes' Rolls Royce at the Exeter Inn in New Hampshire and decided to write down the license plate number to identify who the owner was so they could examine their tax returns. Under further investigation, an IRS agent found that the Olbrezes substantially underreported income on their 1986, 87, and 88 federal tax returns to the tune of $150,954, $748,991, and $175,432 in their respective years. During the audit, through the advice of their legal counsel, the Olbrezes expressed that they were willing to cooperate fully with the audit as long as the IRS doesn't refer the matter to its criminal division. The agent in charge and his superiors immediately presumed the Olbrezes' accountant and legal counsel were not fully cooperating and thus referred the case to the Criminal Investigation Division. Oh my gosh. It didn't take long for the investigation to lead the government to conclude that Anthony and Shirley had committed criminal tax evasion and were indicted related to their 1986, 87, and 88 tax returns. Tax evasion is defined by Title 26 of U.S. Code Section 7201 as anyone who willfully attempts to evade or defeat any tax imposed. It's now the summer of 1983, and we have IRS agents out at the Olbrezes' home to seize assets in what's called a jeopardy assessment. A jeopardy assessment is a special tax liability that occurs without notice. In cases where the taxing authority believes that a person is actively taking steps to conceal assets. In order to avoid a tax levy, they may immediately seize assets. The IRS notes that just a year before, the Olbrezes sold a commercial property and a vacation home, while their family home and yacht are listed for sale, thus the jeopardy assessment. In their defense, the Olbrezes said they were only trying to liquidate assets for the purpose of reducing debt and not to frustrate tax collectors. Besides, their accountant told them to do it. Yeah, because of the pending tax bomb that's going to be dropped on them from the audit. Even though the Olbrezes had sold some properties, none of the money had gone to the government. The jeopardy assessment against the Olbrezes was for $1.8 million that made a past due income tax, penalties, and interest for years 1986 through 88. The IRS ended up seizing a 1987 Range Rover and bank accounts. And guess what? They couldn't find the Rolls Royce. The Olbrez's 1987 tax return originally reported $1,235,069 in business gross income, not net, and $30,000 in gross rental income. The IRS found that they actually had $1,962,170 of business gross income and $51,890 of rental income, a 37% understatement. The IRS didn't find any misfeasance in the calculation or misapplication of accounting principles from their tax returns. So that means the big issue here is not reporting all of their income. No alterations to the existing records were found during audit. No false invoices or documents were produced. There was only incorrect accounting entries by Shirley, like recording a customer receipt as a loan proceed, for example. During the audit, the IRS found that there were deposits of $718,000 made to the business savings account and other accounts. Part of Shirley's accounting workflow involved maintaining an invoice log that recorded all business invoices sent out and payments received. Shirley also kept a cash receipts journal in which she recorded all business receipts into their business checking account. There was no journal kept for deposits made into the business savings account. The invoice log and savings account journal for 1987 was never produced during the audit, conveniently, but the cash receipts journal was. It was only when the IRS issued a summons to the Olbrez's business bank that they discovered the savings account. Anthony and Shirley asserted that they did not intend to file false returns and were not aware of the substantially understated income. Our CPA Wilson will surely shield us from any wrongdoing, they thought. However, Anthony nor Shirley discussed their prepared tax return with their CPA in detail and did not even look over the tax returns when they signed them.
Oh my gosh.
Pro tip, review your tax returns before you sign them if you didn't prepare them. Wilson reported the interest income from the business savings account but didn't account for the deposits that were made into the account that generated the interest. A large increase in interest income in an account shouldn't automatically throw off red flags because the Olbrez's could have simply transferred money from their checking to their savings account. However, Wilson could have asked about the increase in interest income compared to prior year, and if he asked that question, the Olbrez's may not have underreported their income. The IRS was able to demonstrate that the Olbrez's spent more money in 1987 than they would have had available according to their tax return. The IRS argued that it should have been clear to the Olbrez's when they filed their tax return that something was wrong. I mean, maybe if they actually looked at the return. It was noted that Anthony was not personally involved with providing information to Wilson. It was always Shirley. Shirley's accounting and financial management was described as deplorably negligent and primitive and disorganized. Missing from the gross receipts were rebates from shipping companies, and it was found that the Mayflower Shipping Company failed to file a 1099 to the Olbrez's business and to the IRS. No 1099, no taxable income, they thought. Wilson knew there were rebates. They were indicated as commissions on his work papers, but for the wrong amounts. It was found that Shirley deposited the rebates to a bank account for the rental property. The rental income was underreported because Wilson relied on handwritten notes by Shirley and didn't compare it to the lease agreement that Wilson had access to. We don't know what Wilson had to say about this because he died before the trial. The Olbrez's ended up being acquitted on all 3 counts of tax evasion by the district court because the jury could not, beyond a reasonable doubt, believe that all the evidence showed that the Olbrez's intentionally defrauded the government. It took the jury 3 days of deliberation and was deadlocked at one point. The story doesn't end here though. The government appealed the acquittal and was able to reverse the decision. During the appeals trial, the IRS brought up a projection created by Wilson with information provided by Anthony. They had estimated a total of $1,976,000 of revenue for 1987. Actual gross receipts was about $2 million, so pretty spot on. The tax return ended up reporting $1.2 million of gross receipts. It was argued that a rational jury could infer that Anthony had enough knowledge of design consultants' financial matters to recognize that something was wrong on their tax return. Again, if he even looked at the tax return, or maybe they were lying, they never even reviewed the tax return. It's getting pretty sus now. The Olbrezes countered with, the evidence just means that we are really bad at record keeping and accounting. But Anthony admitted that he knew the transportation rebates were taxable. So it seems like they were trying to take advantage of Mayflower's failure to issue them a 1099. In court, the agent in charge testified that Wilson, the CPA, had once stated that Anthony had acknowledged a problem with unreported income relative to the 1987 tax return. Yes, I think there's a problem. Shirley testified that she did not know the rebates counted as income, but remember, she deposited the rebate checks to a bank account unrelated to the business. The appeals court ended up reversing the acquittal, holding that there was evidence of willfulness sufficient to uphold the conviction. Here were the findings. The Olbrezes signed the 1987 tax return. They knew the contents of the return at the time they signed, and they knew it significantly understated taxable income. They knew their business had made substantially more money than the return reflected. They had received revenues during the tax year, which they knew were taxable, such as business receipts and transportation rebates, yet they neither deposited those revenues in the business checking account nor recorded their receipt in the usual manner, but instead diverted the revenues to other bank accounts. They deliberately understated the amounts of rental income received when transmitting data to their accountant preliminary to the accountant's preparation of the tax return, and they withheld materials from the accountant and later from the IRS auditor that would have pointed to the existence and extent of the undeclared income. The court found that the Olbrezes owed $632,158 to the government. The district court originally sentenced the Olbrezes to 18 months in prison, the lowest possible sentence for their crime. The court rejected the Olbrezes' argument that there should be downward departure from their sentence because their employees would lose their jobs and they are innocent. A downward departure is when a federal judge imposes a defendant a sentence that is lower than the minimum sentence that was suggested by the sentencing guidelines. It was noted that the business would not fail if Shirley was incarcerated. Shirley ended up being sentenced to 15 months in prison, and Anthony just 2 months, followed by 11 months in a halfway house. Anthony was 56 and Shirley was 50 years old when they were sentenced to prison. The judge imposed a lesser sentence on Anthony because the business would fail without him. There was a ton of legalese in this case, and I left out a ton of nuance that would have pleased the law geeks, but I didn't want to butcher the legal side of things more than I already have. From a CPA perspective, I think this situation would have been avoided if the Olbrezes' accounting was properly organized and a third party was responsible for the bookkeeping. Oh, and if they never bought that Rolls Royce. I can see how Wilson was misled and filed a tax return he thought was accurate and complete based on the information given to him. I think Wilson did fall short by not inquiring why their 1987 projection was significantly different compared to their actual tax return. Tax professionals that sign a tax return are required to perform their due diligence and ask questions to find the truth for situations that seem questionable. We can't simply be given information to prepare a tax return and take that information for what it is if something seems off. I believe Wilson had enough context of the Olbrezes' tax situation to know that something was off and thus failing to perform his due diligence. Was Wilson colluding with the Olbrezes? Did Wilson have information that would have made the case more black and white? We'll never know. What I do know is preparing a 1099 could help prevent tax evasion. Thank you so much for watching. Please subscribe if you want to see more of this type of content. Wow, this was a crazy case.